Ever notice how governments promise everyone more financial freedom and opportunity? It sounds great, right? But when we step back and look over 2,000 years of money history, a different story starts to emerge. Instead of lifting up ordinary people, there's been a secret playbook at work, one that quietly funnels wealth and power up to the state and its elite friends. Let's pull back the curtain and explore how this pattern has played out through the ages. Imagine if your money slowly lost its value without anyone telling you. That's essentially what happened in ancient Rome. Back then, emperors needed cash for huge armies and wars, but taxing people openly was risky. So they did something sneaky. They kept minting coins and made them worth less over time. A coin that started almost pure silver ended up mostly cheap metal, though it still looked shiny. People on the ground saw prices soar and their savings vanish. We don't use silver coins today, but the same trick is alive. Modern central banks just print new money out of thin air, called quantitative easing, and that quietly erodes the purchasing power of our dollars or euros. In other words, the coin is gone, but the trick of making money from nothing to devalue what you hold is exactly the same. Fast forward to the Middle Ages. Kings and queens needed treasure for wars or palaces, but often ran out of it. What did they do? They invented a brutal solution called the forced loan. Picture this. A wealthy merchant or noble gets a royal command to lend the king a pile of gold. It isn't really a loan at all. It's more like an order. You couldn't just say no. If you refused or hesitated, the crown would seize your lands, throw you in prison, or worse. To make it look better, the king would promise to pay back with interest, as if it were a patriotic sacrifice for the realm. But these promises often turned out to be a sham. When it was time to repay, the payments were late, made with devalued coins, or quietly scratched off the books. In the end, it was just a way for the monarchy to grab rich people's money for endless wars, without the backlash of openly taxing everyone. By the late 1600s, monarchs found a new, more polished method. In 1694, England created the Bank of England to fund King William's war with France. Here's how it worked. Rich investors loaned money to the government by buying bonds that promised a steady interest payment forever. Sounds reasonable, but there was a catch. The money to pay that interest had to come from future taxes. And who paid those taxes? Mostly everyday people buying basics like salt, leather, beer, and coal. In effect, ordinary folks were footing the bill so that wealthy investors got a safe, risk-free income. This setup was dressed up with fancy terms like sound finance and public credit, but it really formalized a one-way wealth transfer. Over time, lending to the government became known as the safest investment, because the government can always use its power to tax everyone to pay its debts. The result? A permanent circuit where the rich got richer with guaranteed interest, and everyone else carried the cost through taxes on daily life. Today's governments have taken those ancient tricks and given them a high-tech upgrade, but the goal is much the same. Deficit spending and the bondholder bonus. Modern countries borrow massive sums of money, claiming it's for roads, schools, or healthcare. In reality, a big chunk often flows to military projects, subsidies for big companies, or bailouts. When the debt comes due, how does it get paid back? Usually through three punishing methods: higher taxes, hidden inflation, and cutting public services. Ordinary people feel the squeeze of price hikes and budget cuts, while the rich investors who bought the bonds collect their interest payments. We're told this is investing in the future, but in practice it means everyday citizens shoulder the burden while bondholders enjoy a guaranteed profit. The bailout doctrine. Take the 2008 financial crisis, for example. Big banks were gambling with risky mortgages and fancy financial bets. When the house of cards collapsed, governments and central banks swooped in with trillions of dollars, not to help families, but to rescue those banks deemed too big to fail. The result? Private losses, from bad bets, were shoved onto the public's shoulders. Taxpayer money covered hundreds of billions of bad debt, while the bonus money and profits in the boom years stayed with the bankers. This created a dangerous game. The winners keep the gains, and when it blows up, it's everyone else who pays the bill. The generational Ponzi scheme. Pensions. Even something as sacred as your retirement savings gets caught in this web. We all dutifully pay into state pension systems, think Social Security or similar programs, trusting our future selves will get that money back with interest. But most governments don't actually set aside that cash. Instead, they spend it on today's budgets and give us a paper promise, an IOU in the Treasury. It works like a Ponzi scheme. As long as a growing number of younger workers pay in, current retirees get paid out. But demographics are shifting. Fewer kids, more retirees. The system's math starts to break. When that happens, governments don't magically dig up money to fulfill the promise. They reform the plan, meaning they slash benefits, raise the retirement age, or simply let inflation erode your payout. In the end, the golden retirement dream comes at the price of the younger generation funding the older one, while the original promise quietly shrinks. The mastery of illusion, sophisticated modern tricks. The modern era adds even more layers of sleight of hand to hide how the system really works. Quantitative easing, QE. This is the central bank's signature move. They literally create money out of thin air, thousands of new banknotes typed into existence, and then use it to buy government bonds or other financial assets. The immediate effect? Asset prices shoot up, stock markets rally, real estate values climb, bond prices rise. Who benefits most? The richest 10% who own most of these assets. Everyone else? We see the price of everyday things go up, like rent and groceries, with no corresponding jump in our paychecks. In short, quantitative easing quietly transfers value from savers and workers to the wealthy asset owners. Regulatory capture. You might think laws and regulations protect you from the big banks, tech giants, or drug companies. In theory, yes, but in practice these powerful industries often are the regulators. Executives from the very companies being watched often end up running the regulatory agencies. The rules get written to protect the incumbents, not to help newcomers or consumers. It looks like there's oversight, but it's more like a friendly handshake behind closed doors. This capture of the watchdogs means competition gets stifled, and big players keep their profits safe, even as we believe these agencies serve the public good. The weaponization of complexity. Perhaps the most cunning trick is complexity itself. The financial and tax systems are made deliberately confusing. Imagine tax codes running to tens of thousands of pages, budgets full of jargon and hidden clauses, and exotic financial products that only a few specialists can understand. For the average person, it's impossible to decode all this. Why make things so complicated? Because when few understand the rules, almost nobody notices how wealth is being shifted. It's like hiding a heist in a fog of numbers and legalese. As long as the details stay murky, public scrutiny is almost impossible. This engineered confusion ensures the wealth transfer continues unchecked, right under our noses. The pattern and the path to resilience. Step back and you'll see a consistent theme. The language surrounding all this is twisted to sound positive. Rising inflation isn't called what it is. It's dressed up as strong growth or an overheating economy. Huge government handouts to banks or industries are not called giveaways. They're rescuing stability or protecting jobs. Tax cuts for the wealthy become trickle-down economics. Even gutting social safety nets gets labeled necessary reform or fiscal responsibility. In reality, it's all marketing for the same goal: shifting wealth upward and keeping people dependent. This isn't a bug in the system. It's exactly how the system was built to work. If you want to protect yourself, knowledge is your best shield. Brush up on financial history and money basics. Get comfortable asking the toughest question whenever a new policy or crisis pops up. Who really pays and who really wins here? That simple query, cui bono, can cut through a lot of the spin. Finally, think about keeping some of your wealth in places the government can't as easily control, things like certain assets or currencies outside the system, whatever makes sense for you. In short, understand the game so you're not playing a sucker's hand. From the clipped silver coins of ancient Rome to today's digital money, one fact remains. The hidden goal has been the same for 2,000 years. Concentrate money and power at the top and make everyone else pay the price. The tools have gotten fancier, but the game is on repeat. History might not repeat exactly, but if you listen closely, you'll hear the echoes. The only real question is whether you'll learn those lessons in time to safeguard your financial freedom and break the cycle. It's up to each of us to read the playbook, ask the right questions, and chart a smarter path forward. By subscribing, you can gain the knowledge needed to chart your own path and possess the power to do so.